for joining our Upside Avenue educational webinar series. This series was developed with your input. We surveyed our investors and followers to find out what financial and investment topics everyone is interested in learning about. And then we look for subject matter experts all throughout the country who can speak on these topics in hopes of providing you with the knowledge and confidence to help you discover your upside. So subscribe at upsideavenue.com to know when our next webinar is, or you can also follow us on social media. Now, this presentation is for general informational purposes only, and Upside Avenue recommends that you do your own thorough due diligence and research before acting on anything suggested today. And for today's presentation, I am in awe of our panel today. To celebrate women and Women's History Month, we are among some giant movers and shakers in the financial planning space. We have 3 certified financial planners from MainStreet Financial Planning with us to talk about women and smart investing. First, we have CEO and President Anna Sergunina. She was named a virtual force by Morningstar and recognized by Financial Advisor magazine as a top 10 young advisor to watch for in 2017. She is also an advocate for financial education and has contributed to publications like Forbes, Business Insider, USA Today, NASDAQ, and the Wall Street Journal. We also have with us Liz Gillette with us. She is a consistent contributor to the financial planning industry and currently hosts a series of money management seminars for hearts and homes for youth. Her aspiration is to bring clarity and simplicity to personal finance while aligning clients' unique personal values to their spending. And finally, we have Rachel Claussen. She is a certified financial planner at MainStreet, and she enjoys tying fitness and finance together to help her clients discover the why behind their goals. She says that you are the hero of your story, and Rachel is simply your coach, guiding you through living out your unique financial plan. So help me welcome our friends from MainStreet Financial Planning, Anna, Liz, and Rachel. Welcome, ladies. Thank you so much for joining us today.
Thank you for having us.
Before I turn the time over to you, I wanted to get your reaction on this headline from last year. Do you have any thoughts on that?
It does make us laugh a little bit, but it's just really truly the reality of the world that we live in. And we've heard this many times as we embarked on the journey to work with our clients, but is it true? No. As my 2-year-old will say, no. So yeah, we do want to demystify all of these things that you're seeing here on the screen, and actually really give you some tangible, practical things that you can put in place, so you don't end up feeling like somebody's telling you that you cannot accomplish something, or you're going to be making less, or all of these things that are, the reality of the world we live today.
Perfect, thanks. Well, I will turn the time over to you now.
Thank you so much, Jessica and Upside Avenue. We're excited to be back. We're beyond excited because when we heard that there was an opportunity to speak to a group of women, so that was like definitely yes. And then when you asked us to speak on the top of investing, you're like, okay, well, there's 3 of us and we can talk for days on this topic, right? But we only have so much time today, so we want to, like I said, give you practical tips and things that you can really start putting in practice like today. We are financial planners. We're not investment managers. There's a big difference between what an investment manager does versus what a financial planner does. And I'll talk a little bit more about that, but we are focusing on investments because investments are the big component of your overall financial plan, but it's not the only thing that we need to focus. So just kind of, get started with that thought. a bit of a disclosure that nobody wants to read, but just like Jessica mentioned, you need to, this information is for educational purposes. And if you need more specific legal or financial or accounting advice, you got to seek help for that. So here's what we're going to focus on today, since we're talking about investing and how women can really, get into this space, or if you are already started, what are some of the things that you can actually do better? So we'll talk about the reality, just like what Jessica shared. There's some things that actually just happen in our society and we have to deal with it. But then we're going to dive into understanding how investments work. So in understanding investments and really just starting to dip your toes isn't just for our male counterparts, right? It isn't just for the people who are older. It is for everybody. And it's just unfortunate that we, the three of us here, chose a career of financial planning for various reasons, but for one is because we wanted to help folks like you be better with that. So you don't have to become financial planners to really get started. So we're going to talk about mistakes to avoid. And do we know those mistakes? We do, because we see this a lot, all the time, all day long with our clients. And then, of course, what are some planning considerations for you to take away? Again, kind of piggybacking on what I said about us being planners. We always have that in the back of our head. So, and thank you so much, Jessica, for your introduction. I am really excited not only to talk about this topic, but really for the last 17 years that I have been in this industry, it has shifted quite a bit. And I've always thought that when I started that I would have to work with clients who are my parents' age or grandparents. So they would always have to be older. Most of them were, the relationships were dominated by males. And so I always thought I would have to have gray hair in order to be taken seriously. Well, fast forward, I have grown a few gray hairs. You can't see on Zoom, but I am even more excited today because there's a lot, the world is different. And I personally get to work with clients that I enjoy to work, and I enjoy advising, but also it doesn't have to be, someone who doesn't take me seriously. So I really love the educational piece of this industry. And so not only clients, but our team, which is very different from what you see in financial services, but we are women-dominated company versus man. So we take a lot of pride in that. But yeah, I'm very excited to chat with you guys today. Rachel?
Hi, it's great to be here with everyone today. I'm Rachel. I'm the newest member to MainStreet and so happy I got to start working with the team here. I've been in the financial services industry for about 4 years, and I started off kind of like Anna described in the money manager world, which was so much fun. And I love talking about investing and making your money work for you and how can we put all this together in a financial plan. And so now I've gotten to take that one step further by joining MainStreet, where we're really planning first. And I just love helping clients find the why behind why are you building this money roadmap? What do you want your life to look like? And I always, when I get asked, I always tell people like, my goal is to help you live out your dream life. And I do that through financial education. And so I'm really excited to be here today to talk with you guys about that a little more.
Awesome. Liz, welcome.
Hi, everyone. I am Liz Gillette, obviously another advisor here at MainStreet. Thrilled to be here, Jessica. Thank you for having us to be talking to you here today. Just like Anna and Rachel, I'm quite passionate about what we do. I mean, it's one heck of a career. We're not here to turn you all into financial planners, but we do really, really interesting work, helping people plan out their money. As Rachel said, what matters most to them. It's funny that you describe it that way, Rachel. I often tell people my job is to help them manage their competing priorities. Because money is just one more resource. And unless you're in that very select few where it's an unlimited number, for most of us mortals, we're just trying to decide how can I do this, achieve this, be this, and how can I use money as a tool to do that? So I primarily focus in on clients in their working careers, maybe the earlier half of their working careers. Again, just trying to create a life that mirrors their values. I've got a pretty interesting personal backstory. I won't bore you with it today, but let's just say I'm here out of a real passion project for my own financial journey. I really pride myself in a lot of the roles that I play in life that include, mom, wife, daughter, fixer. I'm working on that. I think most of us women are working on that. Somehow I keep signing up for it. But yeah, I'm really excited with the content that we've created for you guys today. This is going to be a great session. So thanks for joining us.
Awesome. Okay, so let's just get started. Before we really get into the nitty-gritty discussion about how investments work and what really it entails, by the way, just thinking back when I was in college and going through a certified financial planner school, like investments class was not my favorite. So just admitting here. So if you're like sitting here because somebody dragged you, or like you're like, I gotta look and pay attention to this, it's okay. All right. So just hanging here because it gets better, I promise you. But before we get into the details of that, let's really look at what is happening in our world today and how these things, right, these headwinds, as we think about them, really could be an advantage to how we get to live our life as women. And that's, I was thinking about this for a while because like, okay, here's the reality. I'm like, who wants to hear again about the reality? We already know that. So like, for example, you guys all heard, right? And maybe even experienced this in your working careers, but women get paid less, 82 cents to $1 as compared to their male counterparts. So you already know that. And a lot of these things, to me, when I think about them, are frustrating as hell, because it's like, well, that's not fair. So it just means that we have to put a lot more energy into something, right, to get the same results. And so, but I always think like, okay, if that's the case, how can I turn this to my advantage? And so that's what I'm trying to really convey to you here. We also, take gaps in our employment, because a lot of times, and I think a lot of women had it even harder over the last 12 or 15 months, right, since we started this pandemic, because of having to take care of their families, right, and being at home and working from home and homeschooling kids, or, if you're just like Liz and I, our kids are not in school yet, they're in daycare. So you can't just put them in another room and put them on the Zoom all day long. You have to like manage all of that. So there's that. The other thing that really is interesting to see, that women are a lot more cautious when it comes to investing. They're a lot more cautious when it comes to saving, right? And maybe that ties into getting paid less for the work that they do, but even just starting, right? And so it takes a little bit of time. Something interesting too that really is not on our side, but we can probably flip it over. Pink tax. Have you guys heard of pink tax? If you have, maybe put a 1 in the chat. But it's an interesting phenomenon. So basically, it's not a tax. It's really just a discrimination on pricing for services and goods that women tend to use. And so, for example, like when you go to, I don't know, a pharmacy or grocery store, so you would find a lot of times items that are like, pink in color, or, like they're tailored more to women, right? So it's maybe, healthcare products, or it could be, it's seen all over. And so a lot of times those items cost, like on average, from 2 to 13% more. And so it's like, okay, well, this is, this one is for guys, this one is for ladies. So like, this is what we're looking at. Now, a lot of it is not something that we're taught ahead of time, right? Or like you're trained to recognize these things. But when you look at the numbers, and we as financial planners get to spend a lot of time with clients looking at their spending numbers, right? And so where are they spending their dollars? It's actually pretty interesting. But I saw a statistic, I've never added up those numbers myself, but it's something like $1,300 a year on average is what women spend more for these kinds of things. So this pink tax, right, is costing us this much more. Does that make me think that I'm gonna all of a sudden switch to buying, I don't know, a blue toothbrush or a blue, I don't know, hair comb? No, I don't think so. Still probably gonna opt out for the pink one, but I'm gonna think about that more often. And the one that I really love the most out of all of these things that are kind of working against us is the fact that we get to live longer. And so I don't know, that just makes me feel really good. And maybe it's just me, and I'm sorry, we love our man for sure, but that's just how it works. Maybe it's just because we take a lot more beating to begin with. So So anyway, average age for women is 81, right? Or average life expectancy, and for males is 76. So just with all of this to kind of take away, what does that really mean? Like, how do you turn this around? And the best way I can put it, and I've been really obsessed with this concept of becoming a money boss, because otherwise we can all feel sorry for ourselves and all of these things, and and really never take any steps. So what does that mean to become a money boss? It actually is, before I jump to the slide, it actually is more about a mindset shift than anything else. And it really comes down to these three things, okay? It's becoming confident, it's being in charge, and it's really knowing what you want. And a lot of these things is what we just discover with our clients through the financial planning process. Now, you don't have to jump into the financial planning process right after this presentation. You can, but a lot of these things you can start to tackle on your own. But the confidence, being in charge, and really knowing what you want are going to help you even, to discover the things that Liz and Rachel are going to talk about today. So here's, with the new mindset, of course, comes a whole bunch of new habits that you have to work on, right? And of course, we want to present to you a new to-do list. So when you look at the landscape of your everyday life, right? Maybe you are in a relationship with somebody, maybe you have a family. So observe and see how, and this all relates to your finances, of course, but observe and see how are you involved, right? Or are you involved in the everyday decisions, right? Or looking at things. So what is your involvement in the overall process? And if you're not, force yourself at some point to be a little bit more interested. One of the things that we really see that makes a difference in all our clients' lives is starting to create that plan for yourself. We call it a money roadmap. And it doesn't have to be anything complicated, but when you start to ask yourself a question of what is it that you really want, then it starts to, in your mind, it starts to connect the dots of, okay, these are the things that I'm trying to accomplish. These are the resources I have, right? This is how it's going to unfold for me. So it naturally starts to help you find those answers. We're going to spend a little bit more time later today as well talking about how do you really look at investments and the risk you take, right? But it all really ties into the bullet point number 2 of what is it that you really want? Because investments, and like one of the biggest secrets around investments is time. It's not the hottest stock that we're going to tell you today you need to pick. It's not. And we don't have any recommendations on that. But it's looking at your timeline. And based on that timeline, you can decide how aggressive or how conservative or how much risk you want to take. And of course, the last one is to complement all of those headwinds that we just talked about. But I challenge you to think about outside of your 9 to 5 box or whatever it is, right? If you don't have a traditional working schedule, really look at what are your skills, what are your abilities, and how can you capitalize on those in order to help you earn more income? Because that is ultimately one of the things that's going to help you get your investment started and help you with all of those things that we're talking in creating a roadmap. And now I'm going to turn it over to Rachel.
All right, so thanks, Anna. I'm going to go into talking about investments and how they work. So just like Anna said, now you're becoming a money boss and you're got all these big goals and things you want to accomplish. So from that is where we work backwards and say, how do we get our money to give us these things that we want? So let's start by talking about different options, what investments are, how they work, and how we can get them serving your goals. So I want to start off just by talking about the different types of accounts. And really there's 3 main categories. We have taxable, tax deferred, and tax-free. You've probably heard all of these terms thrown around and different types of accounts, but just briefly, I'm going to break them down. Your taxable account is what you can think of as like a brokerage account. Maybe you and your spouse open up a joint account at Vanguard, or maybe you have a Robinhood account where you play around the stock market a little bit. All that stuff is, those types of accounts are taxed now. And then we have tax deferred. A tax deferred account is going to be like your 401k, your 403b, a TSP, everything where you put in pre-tax dollars and then you're taxed on that money later when you take it out. So it's tax deferred because you're deferring the tax to when you pull the money out of the account at a later date. And then last, we have tax free. This is going to be your Roth IRA, your Roth 401k. And we call this tax free because you put the dollars in after tax and then it actually grows tax free. You're not taxed on that money again, even when you take it out, because you paid the taxes up front. And one thing I want to mention on tax-free accounts, so like your Roth IRA, for example, that's typically the last money we want to touch. We'll talk about this a little more in investing, but you've all heard of the idea of compounding interest. Well, if you have a tax-free account, then you want that interest to compound for as long as possible. You want to take advantage of all that growth. And so that's where we can put some more of the volatile assets. You have a longer time horizon. The tax deferred account, again, it's sheltered, so you can put some more of the high yielding things in it, like mutual funds and things that are going to be paying dividends or capital gains, stuff like that. In your taxable accounts, that's a better place for like an exchange traded fund, an ETF, something you can control the taxes with a little bit more based on when you sell the products within. And I'll talk about those a little more in depth as we go through the slides. But before we get into that, I want to talk about risk, because obviously risk is something that plays a big part in our investing strategy. And it always sounds like kind of a negative term. We always think of like, oh, if I have all my money in the stock market, I'm going to lose it all tomorrow. And I can't be too aggressive, but I can't be too conservative. Like, where's that balance? And that's a common question that we get all the time. And it kind of comes down to a couple different things. One, it's your personal feelings. Like, what are you comfortable with? Like, how much risk are you willing to take? What would keep you up at night? What wouldn't? And then also, what's your time horizon like? What are your goals? If you have a long time horizon, for example, like your retirement accounts, those can probably be a little more aggressive because you have time to ride out the volatility of the market, and it probably won't keep you up at night, just because those are some of the money that you can kind of set and forget. You're not going to try to touch it in a couple of years, versus if you have a goal of putting a down payment on a house in 3 years, well, that money needs to be more conservative because we don't have time to ride out the volatility of the market before you want to actually pull those dollars out and use them. And so when we're going through risk tolerance, that brings us to our asset allocation as well. And asset allocation is essentially the ratio of stocks to bonds in your portfolio, equity to fixed income. And when we think about that, we're wanting to balance risk and reward, really. And this kind of goes back to what I was saying about like what would help you sleep at night. And when it comes to determining what's the best mix for yourself, well, it depends on your goals, depends on your time horizon. But we have two types of risks to consider when determining your asset allocation. We have like stock market risk, which is what we typically think of initially, like how aggressive can I be? How much risk can I take on? But then we also have risk on the other end of the spectrum, known as inflationary risk, or losing your purchasing power. So if you don't want to say, oh, well, if I don't put any of my money in the stock market, then I have no risk. Well, unfortunately, that's not true, because if you just leave all your money under the mattress or in a savings account at your bank, then you're not going to keep up with inflation. A dollar today is not going to be worth the dollar in 10 years if it's not experiencing that growth. Inflation is going to beat it out. And so it's about finding that balance. And again, that ties in with our goals and your overall plan, which I'll go into more detail a little later. And the last thing I want to mention on risk and associating with your asset allocation is we also don't want to be reaching for risk. Like, I think all of us, when we're working with our clients, we're not ever saying like, oh, just take, you feel like you want to be aggressive, cool, let's just reach for as much of a return as we can get. Well, the stock market, if you treat it like Vegas, you'll probably get burned, and that's not what we want. The goal isn't to just try to take on as much return and risk as we can get. What we want is just to have our money serving the goals that we have associated with it. It's thinking about what's important to you. Is it buying a house? Is it traveling, paying for your kids' college? And then what's the appropriate amount of risk to take in the asset allocation that supports that to reach those goals, not just reach a number. And So that brings me to talking about asset allocation and your age. This is one tool we can use, one gauge we can use when helping you come up with the asset allocation. I think this is the next slide, maybe. Yeah, thanks. And because that makes a big factor, especially, or is a big factor in determining asset allocation, is our age, especially when we're talking about retirement dollars, which is obviously one of the most important categories when we think of investing in our portfolio. So someone who's got a longer time horizon, maybe they're 30 and they're going to retire at 60, 30 years is a long time. So you can see here that they can take on, they would have a little more aggressive asset allocation because they have time to take on that risk, versus if someone's in their 50s or 60s and maybe they're only 5, 10, 15 years from retirement, we're going to want to scale that back. And again, balance that risk and reward, because we're going into retirement. We're going to start pulling those dollars out. So we don't want to experience the severe volatility of the market that you would with a more aggressive asset allocation. So next I'm going to go into talking about, so we have these kind of like general investing strategies of risk, allocation, tying that to our goals. But you're probably wondering, like, what do I actually put my money in? Like, I have these accounts, I know I have 10 years to this goal and I have 30 years to retirement. What should I actually be putting my money in? So I'm going to talk you through just kind of the main categories of the various vehicles that you can invest in and kind of what they would do for you, what their purpose is, and just the basics of how they work. So obviously the primary two categories are stocks and bonds, equity, fixed income. Stocks, you're owning a portion of a company, right? You're buying shares of Apple or Tesla or Microsoft. Bonds, CDs, that fixed income side is you're lending money to government, to corporation, whatever type of bond or CD it is. And you're lending that money for a certain period of time in exchange for receiving dividends, interest payments over time. And then when that matures, you get your principal, the amount that you put in, you get your principal back. Also, on the kind of fixed income savings side, the last thing I'll mention is a high yield savings account. That's similar to like a savings account, obviously, and in a higher interest rate environment. Obviously, we're not experiencing that right now. Those are a greater place for us to be parking our money for some of those short-term goals. Right now, you're probably only earning like 0.4, maybe 0.5%, but at some point that'll come back up, you know, and those high yield savings accounts will do a little more work for us. So, all right, now I'll go to the mutual funds, sorry. Okay, so we have our stocks and we have our bonds, right? So aside from investing in an individual stock, like buying shares of Apple or buying a individual bond, you can also buy more efficiently in a more diversified way. You can buy baskets of securities, and those are mostly broken down into a mutual fund or an exchange traded fund. Both are, like I said, baskets of securities. So you're buying one fund, ABCD fund or XYZ fund, and within that, you're getting exposure to hundreds of different companies to provide diversification within your portfolio. You're not putting all your eggs in one basket, like for example, as if you were to put all your money into Tesla or something. You know, you want to have a little more exposure. Again, don't put all your eggs into one basket. So that's the beauty of mutual funds and ETFs. They're more cost effective. And the primary difference is a mutual fund, it trades once per day. So if you were to log into your account and purchase $1,000 of XYZ fund and place that trade at 10 a.m., if you're on Pacific time zone, that trade wouldn't actually process until 1 p.m., the close of the trading day. That's when those funds are priced, and you actually buy the shares of that fund. An ETF, an exchange traded fund, trades like a stock. So if at 10 a.m. you logged in and you bought 1,000 shares versus dollars shares of VWO ETF, at 10 a.m. in 3 seconds, it'll probably be processed in your account, just depending on how liquid the fund is. But so that's the primary difference between those two. One trades at the end of the day, one trades more like a stock. The other major difference, which I kind of mentioned earlier, is ETF is going to be more beneficial to have in like taxable accounts, because you can control when you're going to be paying taxes. So basically when you sell the fund is when you would pay taxes if there's a gain or a loss. But a mutual fund is going to, a lot of them will be paying dividends or capital gains. So you want to have those in a tax sheltered account, because you can't control when that mutual fund company is going to be distributing those to. So you pay taxes on that when they are in the year that it's processed or paid out, excuse me, if it were in a taxable account. But if you have it in something like an IRA or a Roth IRA, then it would be sheltered. You won't have to worry about that. So next, I want to talk about target date funds. So we've talked about stocks, bonds, we have mutual funds, we have ETFs, which are kind of basket options of those. And now we have a target date fund. So a target date fund is a mutual fund, basically, but it's a specific type of mutual fund wherein the allocation is, the asset allocation automatically changes over time as the time horizon shortens. So these are almost always an option in your employer sponsored retirement plans, so like a 401k or a 403b. In the TSP, they call them life cycle funds, but you'll see it in your investment options as like target date 2050 fund. So you would want to choose that fund if it's in your retirement account, if you were thinking, yeah, 2050 is probably about when I would retire, because what's going to happen, so that's 30 years from now. The asset allocation of that fund currently is probably 80–90% stocks, so it's pretty aggressive, and only 10–20% bonds. But as you approach that retirement date, as we get to 2040, 2045, 2050, that asset allocation is going to become more conservative, and you'll be at 10–20% stocks and 80 or 90% bonds, because again, your time horizon is shortened. You need take less risk because you're going to start accessing those dollars. Another common place that we find these is in college savings accounts. So like a 529, say you have a child this year, you're going to be going to college in 18 years. You could pick a target date 2035 or 2040 fund, something that's going to have that asset allocation automatically adjust for you as your child approaches the time when they'll be using those dollars to go to school. We always love suggesting target date funds, especially if it's in a new account, like you start a new job, contributing to your 401k. A target date fund is a great place to start because it provides that diversification that we're looking for. It's low cost. It's going to automatically adjust the asset allocation, and you can just like set it and forget it. And we typically recommend providing more diversification in your accounts outside of the target date funds. Once your account grows more, I always say like once it's getting around the 100K mark, then it's a good time to start further diversifying into some more international exposure, real estate, like short, intermediate, and long-term bonds, just to give you, when your account reaches a certain size, then it makes more sense to start diversifying out of that a little bit more. But a target date fund is the perfect place to start, and a great place, especially for your child's 529 accounts, where you can just set it and forget it until they're heading off to school. So the last fund I'm going to talk about, since Upside is our awesome host today, putting this on for you all, I had to talk to you guys about what a real estate investment trust is, a REIT. And REITs are very unique because they're not really, it's not like they're truly a mutual fund. They're not an ETF. They're kind of their own category, but they're modeled after a mutual fund. A mutual fund, a REIT, it pools the capital of investors, and it makes it possible for you as an individual investor to earn dividends from real estate without actually having to buy and manage or finance a physical property. So it's an alternative way to invest in real estate, which is a great piece to have of your overall portfolio, of the overall puzzle. And it gives you some, having that real estate or the REIT exposure gives you some added diversification outside of just your stocks and bonds, because real estate doesn't move directly in line with the market. It's not, if stocks are up, real estate's up, if stocks are down, real estate's down, or vice versa. It kind of has a mind of its own, if you will. So it's a good vehicle to have in your portfolio to help ride out the volatility and just give you some additional exposure and diversification. I'll just mention there's a couple different types of real estate investment trusts. There's public and private REITs. A lot of them are publicly traded, and you just buy them on a stock exchange like you would a mutual fund. And then the type of REIT, you'll see there's equity REITs the type of REIT determines how the income is paid to you, how those dividends are paid to you. So if it's an equity REIT, then the fund is owning and operating income producing real estate. And so that income that the properties themselves produce is then passed through to you, the investor, in the form of dividends. If it's a mortgage REIT, then that fund is holding the mortgages on those properties. And the income that's earned is based on the spread between the interest the loans earn, those mortgages earn, and the cost of actually funding those loans. So that spread there is the income produced, and that is passed through to you, the investor, in the form of a dividend. And then you have a hybrid REIT, which is a mixture of both equity and mortgage REIT. So they hold both the properties and the mortgages to produce income. And as you've heard me say several times now, this is an income producing fund, or that is one of the goals of it. So it's best to have these, again, in a tax advantage account. If you have it in a taxable account, you're going to be on the hook for paying taxes on that income every year, versus if you have it in something like a Roth IRA, you would only pay taxes on, actually, if it's Roth, you won't be paying taxes at all because it's growing tax free. But if it was a IRA tax deferred account, then you'd just be paying taxes when you pull the money out. So those are the basics of just kind of the different types of vehicles you can invest in, and just types of funds. I know it's kind of a lot of info thrown at you, but definitely feel free to ask us questions at the end. The last things I want to talk about is tying this into our financial plan and the goals that Anna was talking about at the beginning, and that Liz is going to talk about a little more at the end. And at MainStreet, we like to think of when we're building out a portfolio together, we think of your money in terms of buckets 1, 2, and 3. It's just a nice framework to build our investment strategy within. Because just about everyone has short, mid, and long-term goals, right? And we want our money to be aligned with those goals, not just a number in the bank. So we break it up into these buckets. We have our short-term goals, which is money that you want to use for something that's happening within the next 3 years, more or less. And so if it's something that short term, we don't really want any stock market exposure. It's probably going to be in something like a high yield savings account, something that we're not putting at risk of losing within that time frame of wanting to use it. Then we have our midterm bucket number 2, which is midterm goals, stuff that's going to happen in that kind of 3 to 7 year time frame. And this can have some stock market exposure. We're thinking 25 to 50%, depending on your risk tolerance, what personally you're comfortable with, and where that goal falls within that time horizon. And then bucket 3, that's going to be our longer term money, stuff that's going to serve goals that's 7 years or more out. And this would be our most aggressive bucket, something with 50 to 100% even in stock market exposure. Again, depending on your risk tolerance, what you're comfortable with, and where your goal falls within that timeline. And so the last thing I'll show you is just kind of a visual of this, of our buckets of money. This is one of my favorite slides because it really shows us how we're balancing our risk tolerance and our asset allocation and kind of where we fall on the spectrum. And the buckets of money is so important when we're creating our financial plan as that framework, because as we go through life, all these goals we set out, these milestones, obviously we achieve some change as time moves forward, goals get closer, something happens, a new goal gets created, and the money shifts between these buckets. And so when it's not just a number, we can actually attach it to this tangible emotional thing that we're preparing for, that we're planning for, and it helps us stay on track with our plan. Something that used to be a 5-year goal is now a 2-year goal. You experienced a big life change, and now you have a new 10-year goal. So everything's changing, and our financial framework is what's changing along with it. And so those investment strategies and plan that we associate with that should be changing as well. And so I want to turn it over to Liz, because she's going to go into a lot more detail of the planning considerations and some of these pitfalls that we find, which I think will be super helpful in wrapping all this up and making the investment side of things make sense.
Thanks, Rach. That was awesome. Really, I'm so excited with how much information we've condensed in this session. I mean, it really is. I can picture, the participants recording it back, pause, take notes, because we're really trying to give you as much information as we can. Okay, so today I want to talk to you about some mistakes to avoid. Very similar to Anna, I'll keep it upbeat. This isn't a slap on the wrist. This is just a look out for these pitfalls that we know women particularly tend to succumb to. The first one, God, we see this all the time when it comes to investing and frankly, a lot of life's decisions. We know that women tend to wait until we feel like we're an expert, right? We don't apply for the job until we're overqualified and our male counterpart has 1 year of experience instead of 10, and he walks in proudly with his resume. Okay, so I won't make a bunch of man cracks in this section. I'm not a man hater by any means, but this really comes into play when it comes to investing because we know the importance of compounding, right? The sooner you can get the money in there, that's what I show all of the 19 to 21-year-olds at Penn State when I get a chance to talk to them is I say, listen to me, please, if you just get started as soon as you can. Now, none of us can go back in time, so I won't waste time with the shoulda, coulda, wouldas. But if you can just get started, no matter how much it is, you just don't have to work as hard because that compounding is occurring. So knowing that if your thought process is, well, I have to read at least 7 books on it, I got to follow the top bloggers, and I'm not going to get investing until I have this absolutely mastered, we need that time. That time could be better served. So we're really just trying to encourage women and individuals to feel comfortable, to know the base level, right? We don't want you diving into something that you have no idea. We don't want you reading an article on GameStop and throwing all of your money in there by any means. But even today's session should give you enough information to feel like, okay, I'm making a well-balanced decision. The girls have talked to me today about diversification. So just knowing that you should certainly dip your feet in the water and expand your knowledge as you go along, right? We live in this world where there's plenty of information out there. I was just having this conversation on Anna's podcast the other day. You know, it's challenging because in this world, do you follow the person who has the CFP designation? Do you follow the YouTuber has 2 million views, right? Are they equal credentials? So either way, we just really suggest that you dip your feet in the water and you get going in the world of investing. And certainly what Rachel said, the only thing I will add to it, do a little bit of research with passive versus active investing. And I think pretty quickly you'll come up with your answer of which strategy you want to take, right? Which one gives us the best results. The second one, so again, Rachel talked about risk tolerance, which again makes me laugh because we've got conservative and moderate and aggressive. And in this political climate, when I even say some of those words to my clients, they immediately start thinking I'm talking about politics, but I kind of toss those terms out. I say, no, what we're trying to get a gauge for is how well can you handle those swings in the market. And there's a difference between, okay, I feel a little bit uneasy, but I've read the articles, I understand the data. I've got a long time horizon. I should keep my money in the market because it's going to get me where it needs to get. And being the person who's going to log into your account, sell when the market's down, try to time things, right? Those are the exact clients that it's our job to really identify that and to say, okay, that's one of the worst mistakes we can make is to become a statistic and to try to predict and time the market. That's really not the approach that we want you to take. We want you to follow your plan as your guiding force instead of, I had coffee with a girlfriend. She said I should pull money in, pull money out, put money in. So when you have a long time horizon, we really see women erring on the side of conservative, which simply just means not wanting to take on as much money in stocks. And that's a shame because that's a real planning opportunity. That's a real investment opportunity to grow your wealth because it really comes down to selecting that asset allocation. Some of our biggest features are your risk tolerance and your time horizon, right? There's other factors mixed in there, but those are 2 real big ones. So if you can teach yourself through education that you're actually not as conservative as you thought, that you actually might feel uncomfortable, but no one's logging in, then really push for that long time horizon so you can get the most bang for your buck. This third one, oh God, it breaks my heart into 1,000 pieces. We see this sometimes with clients because when you put money into, your retirement account that you have at work, your 401k, 403b, TSP, whatever it is, simple IRA, you typically have this list of investment options. And if you don't select one, your employer automatically picks one for you, typically a target date fund. But when we start moving into the self-directed money, so that would be more of that brokerage account, Roth IRA, IRA, traditional IRA. A lot of people read an article. I hear Roth IRA is a great idea. They take their money, they put it in, they pat themselves on the back, and then they come to the 3 of us and we look at their statement and we're like, okay, good job. You got the money in there, but you might as well have your cash in a savings account, because there's getting the money into the bucket, as Rachel said, right? Think of them as little individual buckets. But if it's just going to sit in cash, that doesn't really count as an investment. So please, by all means, maybe just do a quick one over and make sure that the money that you have in a employer sponsored plan is actually invested and not sitting in a money market fund or kind of a cash fund. This fourth one, we come across this quite a bit, right? As women are making decisions. Anna said she's got a little one at home. I've got 2 little ones at home. And as women are trying to come up with this decision of what do I want to do with my work? Am I interested in staying home? Women or men, right? Am I interested in spending some time with my family, exiting the workforce for a bit and returning? The biggest thing that I would love to pass on to the people on the session here today is just make sure you're calculating that decision correctly. Because what I see is people do a direct line item. Daycare, oof, we know, okay, guys, trust us. I feel it in every being of my body. It's terrible, especially once you get a second in daycare. That's when most women say, okay, forget it. I'm going to take some time out of the workforce. So they think it's an even decision. I make this amount of money. Daycare counts, cost this amount of money. I'll take those years off. I might as well be, with my kid, and then I will return to the workforce. So again, I'm not even going to pretend to speak on all of the other reasons and the emotional decisions. That's going to be up to every single individual. But when it comes to the financial perspective, please don't just see it as income now, cost of daycare now. Because some other things that I want to put on your radar is your Social Security earnings, how much you get in your benefit. How much you get in your benefit is based off of your top 35 years of earnings. So for a lot of women, it's not just the decision you're making now, it's knowing that down the line at age 62, 67, age 70, you will get less in those years, right, that you're receiving your Social Security. Second of all, there's recognizing that you're pulling yourself out of the workforce. So that probably means you're cutting off your pay, your ability to get pay increases during that time, even if they're modest based off of cost of living adjustments. You pull yourself out. What's the likelihood that someone's going to rehire you and say, hey, I know you haven't been here, but let me just catch you up on your salary. So obviously we're missing out on actual salary increases, during that time. Not to mention, when you were working, hopefully you were putting some money away for retirement. So now we're talking about no longer contributing that money, right? So if you're putting 5, 10, 15% away for retirement, and then on top of that, compounding impacts just about every single one of those decisions. So if you're not only putting it away, but you took out those potentially earlier years of your working career, and you took out your years of income, and you took out the compounding. So just some things to think about while we're making this decision. Also, the exact percentage doesn't come to mind, but it's pretty staggering the amount of women that had every intention of returning to the workforce, and how many either end up not returning or end up having to take a significant pay cut because the working world doesn't see the value that they provided all those years of staying at home. The next one, of course, leaving the finances solely up to your partner. I see this men and women. Sometimes we have a lot of women who are taking charge, and the man comes into the meeting and he goes, you make that much? I mean, they have no idea until we're all sitting down together. They say, you have that account? A lot of people use us as a chance to start joining their money together. It is a very, very good idea to make sure that you are involved in the process. And people often say, Liz, what do you think? Is a joint account a good idea? Should we keep them separate? There's arguments on both sides. My biggest thing is I've had clients with a joint account, joint everything, joint debt, joint savings account, joint investments. And then one of the partners doesn't even know where the login and password is. So congratulations, on paper, you're joint, but you're very out of the loop. And then I've had the complete opposite, clients who feel that it's important to keep a lot of their stuff separate, and once a month without fail, they get together and talk about their finances. So definitely just be involved in the process. And of course, it's for the big scary stuff like divorce and if things don't work out with your spouse, but really these are important life skills. And I like to think we can pass them on to the next generation. And lastly, avoiding salary discussions, kind of undermining, not knowing what our worth is, not asking for the raise, not realizing how much are other people in your industry making, what are you giving up, what kind of sacrifices are you making for the benefit of that job, and trying not to steer yourself away from the hard conversations. Okay, so when it comes to retirement, we've given you all this information about investing. Here are some features that tend to throw off the formula. I mean, honestly, Jessica, you can only imagine how often people come to us and say, okay, what is that magic number, right? How much money do I need to retire? No one ever tells me, and I just wish someone, like it's a secret, like we're all keeping it a secret. And so we have to say to them, well, there are so many features that come into play. Right. That first one, if you want to be an early versus a late retiree, as you can imagine, the sooner you retire, I like to think of it as it makes a 2-year difference, not a 1 year, because in reality, you're working one less year. That's the obvious one. But on the other end, if we're not changing your life expectancy based off of that decision, you actually have 1 more year of retirement to pay for plus 1 less year of working. So that's why you see people say, okay, if the math doesn't add up, what difference does it make working 1 more year? It tends to move the needle quite a bit. So think about these things. If you're going to be an early retiree, the other thought process there is, and early is such a general term, but Medicare doesn't kick in until age 65. So if you're thinking that you want to retire before then, and you don't necessarily have access to an employer plan or a group medical insurance, that can be quite a hefty cost. It can easily be $12,000 to $16,000 per individual to be able to cover your own health insurance as an early retiree. Late retirees, we have to start making different decisions about which accounts can we still contribute to. At what point does the government actually force you to take money out of the accounts? This is called an RMD. It now happens at age 72. So really planning out your thinking of, okay, what does my timeline look like? Can I take on more risk if I know I'm going to be a late retiree? Access to a pension, boy, this throws off a lot of the calculation. If you're one of those lucky few who has access to a pension, having a consistent stream of income available to you that you can rely on prior to Social Security, obviously the math traditionally tells us you wouldn't have to save as much as your counterpart who doesn't have that pension to rely on. So being in the DC area, I have a lot of government employees who come in and they have access to a federal pension, and they often find themselves surprised at, if you're willing to keep your costs down, that you don't necessarily have to have this big nest egg to retire on, right? If you can balance your budget and if you've got a pension there for you. Stock options and RSUs, we see these a good amount with our clients, and most of the time it's deer in headlights. I kind of get it, I don't get it. What should I be doing? What should I not be doing? So that comes into a good consideration to think about when it comes to retirement. Are you saving these funds for the long term? Do you want to slowly diversify out of them? Because you don't want to have your employment all reliant on one thing on top of maybe the employer stock, relying on it too. 401k loans, there are real rules when you're switching jobs. Each individual loan policy will say whether that loan is come due, whether they're going to take the money out of that 401k itself. And you would hate to miscalculate and just say, oh, I get to keep this whole 401k balance, because the loan is something to keep in mind. And God forbid, if you got yourself into a situation and you have an ex-spouse, you really want to be educated. How long did you have to be married in order to get some of their benefits? What are your rules moving forward in terms of getting married, where you would miss out on those spousal benefits from all of the years that you two were sharing a household together? And then, of course, other planning considerations. So we've primarily talked here about investing and retirement specifically. Where a lot of our bread and butter lies at MainStreet is really thinking about all the other pieces. That's why the three of us and our colleagues got into this industry. Is it's not so much as sit down, this is exactly how much you have to invest, that's all that matters. That's quite short-sighted if you ask us, right? We need to be thinking about things like risk management. So that comes into, do you have life insurance? Do you have disability insurance? It's pretty amazing how quickly people think of life insurance when 1 out of every 4 of us by the age of 65 is going to spend more than 3 months out of work, right? That's when you'd need to rely on that disability policy. So if your answer is, if my income stopped, that would not work for me or for my family, then you really need to be thinking about disability policies and make sure that you've got coverage for that. Maximizing employer benefits. Our clients are obviously in this day and age changing jobs every couple of years. So that's something that we look at for them and say, okay, what kind of, do you have an HSA, an FSA? How can we maximize some of these features that you have available through your work? Do you need to get an outside policy, like I said, with that disability or life insurance, or can you scoop up as much as you can from the group insurance to get the most bang for your buck? Of course, people think of financial planning when it comes to planning those big events, right? You got a wedding, you got a house, you got some kids' education that you're trying to plan for. So that's something that we do day in and out for our clients, really thinking about, here's where I am now, but how can you help us chart out what it looks like moving forward? And then big purchases. So these would be very similar. I guess a house in theory is a big event and a big purchase. But the next car purchase, the next lump sum that you would need to be able to reach a goal. We hear from our clients a lot too, that when you go on that vacation for the first time, having worked with a financial planner, all of a sudden you're that much more confident. You're like, okay, we can afford this vacation. I feel good on it. That kind of stress that was just in the back, that tension in the back of your shoulders, you feel like you had someone else sign your permission slip, that you can enjoy these big purchases. And of course, managing debt and cash flow. I tell my clients, of all the numbers in financial planning, your savings rate, right? How much of your money do you actually hold on to and get to invest for your future is a huge number when it comes to those clients in the earlier half of their working career. So we talk to clients about managing our debt, what is good debt versus bad debt, and how do you get your cash flow working? Because all of the best financial planning tips in the world, if you kind of come to us with a negative cash flow, that's where it's our job to put it on you and say, okay, only you can move the needle, only you can shift things around, because we need positive cash flow to be able to make it work for you. And go ahead, Jessica.
Thanks so much. Oh my gosh, the amount of knowledge the three of you hold and the information that you've shared here is priceless, honestly. And I know coming from a women-centric perspective, I am so glad we are having this panel, especially in this particular climate that we're in right now. So everyone, go ahead and use the Q&A box to ask these three wonderful ladies any questions that you may have. And I've got one here for you. I have a retirement account at work. What's the next logical investment account for me to open?
Yeah, I can tackle that. If you were paying a little bit of attention, and when Rachel started her presentation, she talked about just different types of accounts and the benefits of each. So what I want to say, you can, and if you remember the chart we had for with different buckets on it. So if you think of your retirement account as something that's for the long term, right? It's going to serve you down the road. It's going to provide for lifestyle and everything you want in retirement. So for most of us, and even if you're closer to retirement, right? Don't think that retirement is that like one stop, right? So when you get there, no, life happens after retirement for many of us. Remember I mentioned women live longer. So, but what it comes down to is the time horizon. So the retirement account you may want to think of is the long-term bucket 3 type of an investment. So what that leaves you with is bucket 1, right? Which is all purpose to service short-term needs or short-term goals. So that means perhaps you need to make sure you have an emergency fund, right? And an emergency fund is just a stash of money. It's not designed to make you rich, but it's designed to help you cover unexpected situations. So do you have an emergency fund? Where is it located? We talked about the types of investments. Could you put it in a savings account? Could it be a money market account? So think about that. And then of course for bucket 2, which for most, and I think Rachel and Liz will agree that that's the type of bucket that most people need to really work on. Like we have our savings accounts, we have our retirement accounts. So like, how do we really fill in that bucket 2? And a lot of times that comes down to a traditional brokerage account, right? That's when you can buy the stocks and the bonds and do all kinds of stuff. And so hopefully that gives you some ideas where you can kind of tackle so that you get all your buckets filled in with proper accounts.
That's fantastic. So how does someone start investing?
Oh, Rachel's trying to talk, but she's on mute.
Sorry.
Yeah.
There we go. My bad.
Hi.
Yeah, that's a great question. I think one of the best things to do, it's like what's that saying of the best time to plant a tree was yesterday and the next best day is today. It's kind of the same with investing. I mean the the starting point is really to figure out what it is that you want, what your goals are, what's your cash flow look like. And then the next step is to just start. And one of the great starting points is, like you mentioned, if you have access to an employer sponsored plan, like a 401k, just put it on there. You want, start 3% or something to just have deducted out of your paycheck. You don't have to think about it. And it's just starting to go away every month like that. If you don't have any savings, like no investing, none, you're just like, I'm brand new. The first thing we always talk about is an emergency fund. I would say that's not investing, that's more like the savings, like Anna said, but it's getting that safety net built in for yourself. And then to answer more like the investing specific, how do I get started? It's probably going to be kind of in that bucket too, opening a brokerage account or a Roth IRA and setting up, just like I've had some clients where I'm like, okay, I just want you to start, and we're going to set up an automatic contribution of $50 every Friday. It's just going to go into the account. It's going to get invested into just a nice diversified mutual fund. And that's what we're going to start with. We set it and forget it. And we just start building those habits. That's the biggest piece, is building those habits that'll serve you over time. And before you know it, you're becoming an investor. You're going to have that mindset, and you're saving for all those goals that you have. And it becomes a lot less scary as time goes on.
Great. We're running up on time here, but I have one last question here. How do I know if I qualify for a Roth IRA?
That's a great question. When it comes to a Roth, as far as qualifying goes, there's an income limitation. So whether you're an individual or a couple, right, as far as filing your taxes, it comes down to whether you're single or married filing jointly, or maybe head of household. The numbers change depending on which tax category that you're in and how you file. But as long as you fall within those income thresholds, then you qualify and you're able to add to a Roth IRA. There's actually a phase out threshold. So at the very front, as long as you're under that number, you get to put the entire, if you're under age 50, you get to put $6,000 in. 50 and above gets to put $7,000. There's a catch-up contribution of $1,000, but you're maxed out at that amount. But then that threshold says, oh, what if my income's in between, right at the top and the bottom of the threshold? And a simple calculation online, there's a ton of them available, will tell you, oh, you can't put the full 6,000. You could only put maybe 4,500 in. But yes, the income limitation is what you want to look for when it comes to a Roth. It's also worth noting that a Roth needs to be earned income. So if you're in a unique situation, some of our clients are retired and saving. So if you're in a unique situation, or maybe you want to start one for a kid or a child in your life, just consider the fact that there needs to be an equal amount of earned income for that year that can go into a Roth. As long as you meet those qualifications, you're good to go.
Perfect. Well, I definitely want to reiterate and say thank you again for joining us and sharing your knowledge on how, as women, we have the same investment choices as men, but our financial planning strategies and needs are really, really different. So thank you for sharing that with us.
Yeah.
Thank you.
This has been
thank you to our listeners for joining us. If you'd like to contact Liz, Rachel, or Anna, we've shared their contact information here on the screen. Also, let us know how helpful this content is by taking the short survey at the end of today's session. And if you have any other financial or investment topics you'd like us to cover, let us know about that. And we'll find subject matter experts like Anna and Liz and Rachel to speak on these topics, because at Upside Avenue, we're committed to helping you live your upside. So don't forget to subscribe to our newsletter and follow us on social media, and check out our library of past webinars at upsideavenue.com/learn. You can discover your upside with Upside Avenue. Through our non-traded Reit, you can enjoy the benefits of multifamily real estate investing for as little as $2,000. You can visit our website, upsideavenue.com, or contact us directly for more information. Thank you everyone for joining us. Stay safe, and we'll see you next time.
Thank you so much.
Bye. Thank you.
Thank you.